Hi, I'm Heather with First Pioneers Federal Credit Union, and welcome to the Money Tips No One Told You podcast. Here at First Pioneers, we love helping you understand your finances better and giving you the tools you need to be financially successful. Here, we're going to talk about financial terminology, how different accounts work. We're going to share tips that make your financial life easier, and so much more. Are you ready to dive in? Well, hi guys, welcome back. I'm so excited about this episode because we have a very special guest here today, and I think we have a topic that you guys are really going to enjoy. Joining me today is our Executive Vice President of Lending. His name is Jeff, and he is just our go-to guy for lending. If you ever have a question, he is the guy to go to, and he is always so helpful in helping people find their way when they need a loan. Hi, Jeff.
Hi, Heather. Thank you for having me.
I'm excited. I think this is something that a lot of people are going to want to hear about because, we keep hearing all these things. The interest rates are going up, which is great if you're saving money, but when you're getting a loan, maybe kind of not so much. And I know they've said that, they're raising the rates so it'll help with the recession or inflation. But what does that mean for lending?
So we've been in this high inflationary environment for a couple of years, largely due to the pandemic. And if you've been in the market for a house or a car, you know that prices have risen significantly. The Fed had cut rates really, really cheap to try to spur the economy in response to the pandemic. And because of that, purchases in general just really really took off, and it forced prices up a lot because you had a whole lot more buyers out there than you had inventory in both homes and cars. And so now we're seeing a situation where the Fed is having to rapidly raise rates. And so, of course, that's trickling down to lenders having to do the same in order to be able to slow down lending. And with that, we've seen less deposit growth. So that right there is another reason in itself as to why other lenders are having to raise rates, is because they're having to pay more money in deposits to be able to get deposits to continue to fund their lending.
Okay, so when we see rates go up like that, don't we find that prices start changing too?
Yeah. So when we see rates go up, then obviously there's going to be less buyers. So it's going to start to bring supply and demand a little bit more into balance. And when that happens, then we're going to see prices kind of leveling off. And that's something that we've started experiencing in recent months, where we've seen both the housing market and the auto market slowing down a little bit. So we're not having like for the credit union over here, we're not seeing as many people having to purchase vehicles for more than the sticker price or more than NADA value. And same thing with home purchases. We're not seeing as many people that are having to get into bidding wars and paying $5, $10, $15,000 over appraised value just to be able to get a house. Whereas we had pretty much all of 2021 and the better part of 2022 that we were seeing that in both scenarios on a regular basis.
Yeah, I remember that. It was crazy how many people were paying so much higher than asking price just to try to get a house.
Mhm.
Um,
Absolutely.
so I'm glad. I guess it's a good thing that has slowed down some. Um, but I guess the question is, people are still going to need cars. They're still going to want to move or need to move where they need a new house. So what kind of recommendations do you have for people that need to make that big purchase?
So obviously, with the higher rates, it's going to reduce your buying power. That right there is a given. Anytime you have a rising rate environment, the good thing about it is that I mean, if you wanted to put a positive spin on it, the good thing about it is that with prices stabilizing like they appear to be doing, you're not forcing yourself in a situation where you have to really make a split second decision, because tomorrow the price might be bid up $5,000 more or something like that. The market is still not it's still not anywhere close to being in balance like it should be, but it's better now than what it was just 3 months ago.
Right. So I guess people can still shop for a rate though. I mean, I guess you want to shop around and find the best rate out there.
Yeah, yeah. So, you still want to shop around and find the best rate out there, because, you're going to have some lenders that are going to be higher. You're going to have some lenders that are going to be lower. It just kind of depends on their, how much they have to lend, really. And that, I mean, more than anything, I mean, that's kind of what dictates you know, how much a lender is going to set their rates at. Is if they have a lot of money to lend, then they typically going to be a little bit cheaper on their rates because they want to get that money lent out. If a lender doesn't have a lot of money to lend, then they're going to raise their rates some to kind of pump the brakes a little bit on lending. So, we always do recommend that you shop around with, whether it's, cars, homes, boats, whatever it is that you're looking at buying, just to make sure that you're not jumping into something that would be at a disadvantage to you.
Right. And one thing I was thinking about the other day, a lot of people may not realize that they may have a credit card or even a loan of some kind that's at a variable rate, which means with these rates going up, the rate they're paying on that card or that loan is going to go up, right?
That is correct. Now, with variable rates, you do have different kinds of variable rate products on there. Some variable rate products that you have out there will the payment itself will adjust depending on the increase or decrease in the rate. Other variable rate products are set at, let's say, for instance, a certain percentage of the outstanding balance. For example, our home equity lines of credit, that's how they're set up. So, in a rising or decreasing rate environment, the actual payment amount would not change simply because of a rise in the rate or a drop in the rate. But you would just have either a little bit larger amount or a little bit lesser amount going to interest than you would had the rise or the drop not happen.
Oh, that's very interesting. Okay. Actually didn't know how that worked. So I just learned something too. Because I think my thought was if you have something that has that variable rate or that higher rate, specifically for carrying debt on credit cards or something, it feels like now is the time to start focusing on paying those down in particular because of that higher rate.
Yeah, and many products out there, credit cards and also first mortgage loans will have that feature there where your minimum payment will change based on the rise or drop in the rate there. So, you could have somebody that their first mortgage is $1,000 a month, and if the rates jump as much as they've done in the last year, then I mean that could raise their mortgage payment another 100, $200 a month or something like that. So it is something to be conscious of, particularly in a rising rate environment like this.
Wow, that's a substantial amount too. Okay, so I've been actually seeing a lot of alternative mortgage products or loan products. In fact, there were several that I wasn't even familiar with. One of them was the adjustable rate mortgage. Do you have any tips on people that are considering that option when they're buying?
So that's a very good question, because we do get a lot of questions about adjustable rate mortgages, benefits, drawbacks of them. Um, and I think for me, it's always been, just a little bit of a personal nature for me to never recommend adjustable rate mortgages, because one of the first jobs that I had out of school was working for a mortgage company that largely or that heavily pushed adjustable rate mortgages. And I basically saw a lot of situations where people were essentially being set up for failure on there. And regardless of, I think, whether you're in a rising rate environment or a decreasing rate environment, I think it's probably better to stick with a fixed rate mortgage because you never really know how long this is going to last. You could listen to experts say the Fed's been raising rates for a year now. They're not going to be raising it that much more. So if you lock in now, then the rates are pretty certain to go down or something. But we don't know. We won't know when the Fed starts lowering rates until we finally get inflation in check. So if you do a 3-year adjustable rate mortgage and the Fed doesn't start lowering rates for 5 years, then you have 2 years right there that you're susceptible to fluctuations, big fluctuations in your mortgage payment there. And so it's really, in my opinion, it's not something that I ever recommend to people when they ask me this question. Now, certainly, if somebody is insisted on wanting to do adjustable rate mortgage, we'll do it for them. We'll be happy to do it for them. But as far as something that I would recommend, it's not something that I would recommend. I would always recommend just going with the fixed rate, even if it's an eighth of a point higher or a quarter of a point higher in the rate, which typically it's not. In recent years, they've kind of put the rates a lot closer to one another. But even if it is a small difference there, it's worth it to pay that little bit extra money to have that security because you never know. You never know what's going to happen a year, 2 years, 5 years from now. You never know. So you're paying for that security, that assurance that your payment is going to stay the same. The principal and interest portion of your payment will stay the same.
Yeah, because it sounds like it could be potentially fairly risky to
It
go
could.
with the variable rate.
Hmm. It could. It could be, and I mean, it could go either way. It could go up. It could go down. We just really don't know. The last time we had a very high inflationary period like this in the late 70s and 80s, and I was a kid at the time, so I never experienced it personally, but just from what I've heard people say about it is that it drug on for a handful of years. So we're only a year into this that the Fed started raising rates. So if this mimics what happened the last time, then we may have another 4 or 5 years left on this before the Fed is at a point where they can start backing off of this. So we really don't know. And if you have somebody that takes out a 3-year adjustable rate mortgage, then you're only fixed for 3 years. So you could have 2, 3 years that rate could go all over the place.
Yeah. Okay. Well, that's good to know. So everybody keep that in mind if that's what you're considering or that's what somebody's trying to sort of get you to consider to do, maybe really look at that before you decide to go that way. One other thing I've been seeing is a temporary buy down. And to be honest, I'm not familiar with that really at all. What is that?
So rate buy downs is something that has been non-existent for quite a while because of the low rate environment that we've been in for such an extended period of time. This is something that we are seeing make a recurrence again because rates have risen so much in over the last year. Uh, what I would recommend is that if you're considering buying down your rate, that you need to speak with your lender to find out exactly how much this is going to cost and figure out the pros and the cons of doing this. If how much money you're going to have to spend in order to get this lower rate versus how long you feel that you may have this mortgage. Of course, no one ever completely knows unless you plan on just buying the house for a short period of time and selling it. But that's really something that you've got to look at on a case by case basis rather than just trying to speak in general terms, I think.
Okay, so that's something that people are really going to need to consider and make sure they have all the facts
That's
before
correct.
they use that option. Okay,
That's
good to
correct.
know. I also hear a lot of people talk about using a HELOC, which is home equity line of credit for those of that y'all that need to know, or a home equity loan to maybe pay down other debt. But one of the things I kind of get confused on with these is Are those fixed or variable rate, and is that really a good idea?
So typically, a home equity loan, a regular home equity loan, will be a fixed rate of interest. It's a closed-end loan, so it's set for a fixed term, just like any first mortgage would. You make the payments on it, and after a set term, whether it's 5, 7, 10, 15 years, whatever it may be, it's paid and it's done. A home equity line of credit is similar to that of a just a regular line of credit where you can draw money on it, you can pay it down, you can draw money on it, pay it down, and the only difference is that it's secured by the equity in your house there. One of the things that I always caution people whenever they're inquiring about that is just to keep in mind that if you're transferring this debt from an unsecured debt, like a credit card, unsecured loan, whatever it may be, student loan, whatever, to your home equity, that you are putting your home at risk for that if a job loss, illness, something like that were to occur. That you're putting your home at risk for that. So um, from a cost saving perspective, obviously it is going to save you a significant amount of money to do that, because typically with home equity you can bundle in a much larger amount there, whereas maybe just getting a small $10,000 $15,000 personal loan, you might be able to go over there and get 50,000 or something like that. It just depends. But as far as home equity loans, we usually see the two biggest reasons that we see people applying for home equity loans are consolidating debt and also doing home repairs, where they're basically using their home equity to put that money back into the home, whether they're adding something onto it, renovating a kitchen or a bathroom, whatever it may be, building a shop in the back of their house, things like that.
Okay. So again, it's another one of those times that let's consider the risk
Mhm.
before
Mhm.
you jump into something like that. Maybe even look at all your other
Mhm.
options before you just
Mhm.
automatically go to your home
Mhm.
equity, I guess.
Correct. And it's also one of those things where everybody's situation is different. So there's no one size fits all for a lot of things like that. So it's really good to talk to your loan officer and just have them sit down, look at what your debts are, look at what your equity is, look at what you're paying right there, and make a little bit more informed decision than just saying, oh, well, I need to consolidate all of this. Let me just go ahead and do a home equity loan and just stick it all in there.
Right, right. Very good advice. Let's see. One other one that I've been seeing is a loan assumption. What exactly is that?
Loan assumptions are where somebody has a home, they have a mortgage that they're paying on, and they want to sell the house, and the lender allows the purchaser to assume their existing loan. I know back in the days, those were a lot more common than they do now. Most lenders now, including us, will require that the loan be paid in full. And whoever it is that would be purchasing the home would have to get and qualify for their own loan themselves. But back in the day, those were a lot more common than they are now.
Right. Okay. That makes sense. The last one that I had seen, and I've seen people do these before. Maybe they're renting a home or something, and then they do some kind of rent to own type situation
Mhm.
with the owner of the home. Is there anything they need to look out for something like that?
So there's a few different options that you have where you have like a rent to own. You can you can sign a like a lease purchase agreement. I'm sorry, where you may have an agreement to lease the house for a year and then have an option to purchase it at either a set price or a price mutually agreed upon at that time whenever the lease is running out. Depends on how the contract is written. You also have what they call in Louisiana a bond for deed. And what that is that is a contract itself where the buyer and the seller will they will enter into a contract where the buyer will make payments to the seller of a set amount for a certain amount of time until a certain price is satisfied. And then at that time, once the entire price is satisfied, then they will get an active cash sale done to transfer the property over into the buyer's name. But while they're under the bond for deed contract, the property still stays in the seller's name, so that in the event that the buyer were to default on there, it's a little bit easier for the seller to get that property back because the property is still in their name. Those are two common options that a lot of residents in Louisiana will enter into when they don't want to go the traditional mortgage route. And there's different situations out there that would bring light to each one individually. For example, the lease purchase agreement, you may have somebody that likes a particular area and says, I'd like to try out that area, see how it is. And then they go over there, they move in, they start leasing the house, and then they realize, what, there's a train track that's 2 miles away, and every night at 11:30 a train passes and blows the horn, and it's annoying. It wakes me up and I don't like it. Or they may get a lot of loud traffic on the road or something, and they say, no, I don't want to do that. Well, in that case, then at the end of the 12-month lease, assuming that that's what they put into the lease purchase agreement, then they can just walk away from it. They're not bound by anything. Whereas if you buy the house and you didn't realize that train track was 2 miles away, or you didn't realize that there was a lot of loud traffic on the road at night or something like that, then you're kind of stuck there for at least a little while there. That there's a whole lot of different situations that would bring forth different, different options there to not go the traditional mortgage route right at the time of purchase there, or right at the time of moving into the property, I should say.
Oh, okay. That's actually a really good option if you want to kind of test drive
Hmm.
a neighborhood or something. I never would have
Hmm.
thought of that.
Yeah.
Um, One thing I know you and I have talked about before is balloon payments, because I
Hmm.
know you don't love balloon payments. Do you want to talk a little bit about that and how that might trip some people up?
So you're right on that. I'm not a fan of balloon payments. And I think the biggest reason that I'm not a fan of balloon payments is because I've seen situations before where someone has gotten a loan, and say, for instance, they're on a 5-year balloon, and at some point during the 5 years, maybe they had a job loss, maybe they had an illness, something like that, that caused them to get behind on some bills. And now, 5 years later, this balloon is coming due, and they still have not reestablished themselves to the point that they can qualify for decent terms. So now they're in a situation where they either have to accept less favorable terms than what they had to begin with, or they can't get financing to be able to to be able to refinance the balloon mortgage, and they lose the house. Now, typically, if it's a local lender, of course, the local lender is going to try to work with them as much as possible to avoid that, because the local lender doesn't want the house. But if it's a larger nationwide lender or something like that, they might be a little less likely to work with them and give them that consideration. So that's always been my caution whenever people have asked me about balloon payment loans. And again, similar to what we discussed with the adjustable rate mortgages earlier, it's another reason why I always default back to the fact that it's better to just go ahead and take the fixed rate mortgage. Even if that rate is an eighth of a point or a quarter of a point higher, you're paying that little bit more money in interest every month to have that security, to know that at certain time you're not going to be running into a situation where you may lose your home. As long as you make your payments every month, you're going to be okay.
Right. And that's just, I think sometimes people don't think about that. They're caught in the moment of, well, this is what I can afford now, or this is going to get me out of the situation I'm in now. But, it doesn't take into account what may happen in the future.
That's correct. And something to be conscious of is that you're entering into something that's going to be a 20-30 year agreement there. So it's always good to think longer term rather than shorter term on that, because I mean, a lot of things can happen over the course of 20-30 years. There's a whole lot of life events that can happen. So it's it always reinforces my stance on the the hybrid options there, that that it's probably just a good idea to stay away from them. So everybody's different. Everybody has different, you know, different tastes and everything like that. But just my personal opinion, it's always a good idea to stay away from them.
All right, I understand. I think I agree with that. Okay, so are there any other ideas that you want to throw out there to help people out?
One of the questions that I get asked a lot, Heather, is 15-year versus 20 versus 30-year mortgages. If you've ever looked into getting one, priced them out, you've noticed that 15 years is going to be cheaper than a 20, 20 is going to be cheaper than a 30. Um, Going back to what I was hitting on just a minute ago about life events and not knowing what can predict, what we can predict in the future. What I do always recommend that people do is not to get yourself in a payment that is uncomfortable. If you're looking at getting a 15-year mortgage, and whatever that 15-year mortgage payment is, you can swing it comfortably, then I'd say, you know what, go ahead and get it by all means. You'll pay a little bit lesser interest rate, you'll save some money, and everything will be great. If you're looking at getting a shorter term loan, like 15, 20 years, and it's really going to stretch your budget to the max, then you would probably be better off getting that 30-year loan and paying a little bit extra money on it every month to maybe try to knock it out in 20 years or something like that, rather than try to go over there and be stretched every month to try to get that 15, 20-year loan, to try to get that loan paid off in 15, 20 years. Because again, you don't know what life events are going to throw at you. You don't know if you're going to get sick and need surgery and have to pay a $1,500 deductible out of pocket. You don't know if you're going to have to change the air conditioner on your house or change the water heater or something like that. Things are going to just pop up, whether it's something around the house, whether it's a repair on a vehicle or something like that. I just had to put my daughter on my insurance because she's getting her license, or she about to have to put my daughter on my insurance because she's getting her license. And so of course that's going to raise my insurance premiums every month, having a teenager on there. So there's a lot of life events like that that can happen over the course of a term. And so I always recommend to people, never put yourself in a situation where it's going to stretch your budget thin. And like I said earlier, if you can afford that 15-year payment comfortably, then by all means, go ahead and do it. We're not going to stop you. But if you feel like it's going to really kind of stretch your budget every month, then you probably need to look at doing the 30-year mortgage, and then you can pay extra on it to maybe try to have that goal of paying it off in 20 years or something like that. So,
Yeah, I think a lot of people don't think about that just because your mortgage says 30 years, you can make extra payments. I know a couple people that had a 30-year mortgage that paid it off in 15 because they were making extra payments. So,
mhm.
there's always options that you can explore.
Exactly, exactly. We it's very rare that you see somebody take out a 30-year mortgage and that mortgage go to full term, because most everybody usually tries to throw a little bit on there, whether it's once a year when they get a bonus from work or they get their tax refund, or they just go over there and throw a little bit of extra money on there, whether it's 100, maybe $200 a month each month, to try to shave several years off that term. So it's very common.
Right. Probably more common than people realize.
Exactly.
Well, Jeff, thanks so much. This has been a lot of really good information. I know with the economy changing so much these days, it feels like, people had financial questions before and it seems like they have even more now. But I guess I'm going to say it again. I say this pretty much every episode, that if you have questions about what's going on with your finances or something that you don't understand, reach out and ask those questions so that you don't get yourself into a situation that you didn't understand and that puts you in a hardship that now you've got to deal with.
Absolutely. We get so many calls from members that jumped into buying a house or buying a car or something like that, and then you realize that they just got really unfavorable terms, and unfortunately by that time it's too late to do it. I mean, obviously there's a lot of times we can go in there and we can refinance the car, we can refinance the home, but if it's something in the price or maybe some kind of service or something like that that was purchased at the time, those, I mean, there's not really much that you can do about that. Yeah, I mean, some of that stuff you can cancel and get a prorated refund, but of course they're always going to prorate it into their favor, so you're going to get a much smaller amount there. So yes, you have a lot of salespeople out there that are, that are commission agents, commission salespeople, and their goal is to try to sell you as much as they can to make, to make money, and not necessarily looking out for your best interest. So that's always something that you need to be cautious of. So anytime that you're making a large purchase, car, home, whatever it may be, always make sure to never get in a hurry. Take your time, do your research, ask your questions, shop around a few different lenders, make sure that you're making an informed purchase and you're completely in the know before you sign your name on any paperwork.
Welcome, everyone, to our Employee Spotlight segment where we get to know our employees here at First Pioneers. We're a big family and we want you to get to know ours. And today we have with us Nevaeh. Hi, Nevaeh.
Hi, thank you for having me.
I'm so glad you're here. Why don't you start with introducing yourself to our listeners?
Great. My name is Nevaeh. I'm a teller at First Pioneers. I've been here about, I think I just passed 9 months.
Oh, all right.
Yeah,
Getting close to that year mark.
yeah, about to make it.
Well, let's get started with your questions. Tell me what show you're binge watching.
Currently, I'm rewatching Fleabag on Prime Video. Yep, I love that show.
Oh, I don't know much about that one. Is it funny or a drama or what is it?
It's kind of like a satirical, like comedy kind of, but it's kind of serious, like a drama. It's amazing.
Oh,
I really
oh,
like it though.
okay. Well, I may have to check that out. I'm looking for something new to watch.
Me
I'm gonna have
too.
to check that one out. Okay. Okay, next question. What is a fun fact that no one knows about you?
When I was 8 years old for my 8th birthday, there was a book written about me for my um, birthday by my grandmother. Yeah, she worked with someone who like had some connections at a publishing company, and yeah, so I have a book written about me.
That is the
Yep,
neatest thing ever.
my name's in it, my face is in it.
Oh my goodness. So that was her gift to you?
Right.
Oh, how fun. I love that. That is a
Yeah,
great.
yeah.
That is so neat. Oh, I love that. I'm so glad you told us that. That is so fun. Okay, and last but certainly not least, tell me something on your bucket list.
I want to travel to South Korea for a good while. Maybe a couple of years, maybe teach English. That's in the future. Yep.
Oh, that sounds like fun. I know other people that have done things like that, and it was always just such a fulfilling thing to do.
Right.
Really
Well, to get a
neat.
head start at the beginning of the pandemic, our senior trip was planned to go to Japan, and then I'd hop over to South Korea after we came back. But things, yeah,
Yeah.
but in the future.
Yeah, the pandemic messed up a lot of things. Well, hopefully, yes, I think that's a goal you should absolutely work for. That will be amazing.
Yeah.
All right. Well, thank you so much for being here. We really appreciate it. And it's great to get to know you a little better. And for all of our listeners, we will see you next time.
Bye.
Thank you so much for listening today. We hope you found this information helpful, and we'd love it if you'd give us a rating. And don't forget to favorite or subscribe to the show. There are several ways you can find us if you need further information or you need to speak with a financial counselor. You can visit us in person in Lafayette or New Iberia, Louisiana, or you can find us at firstpioneers.com. There you can find out how to become a member of our family and find out other financial information. Be sure and check out the show notes for important links and other information. And as always, we're here to help in any way that we can. We hope you have a great day, and we'll see you next time.